mic on, Jim.
I'm great, Greg. How are you?
I am doing great. I got to tell you, Jim and I have the most famous valuation YouTube video out there. So if you ever get a chance, and Jim is I'm not going to do his big formal, he can tell you a little bit more about himself, but if you want to understand anything about Duff and Phelps and all the things you never thought about that are available, this man not only knows them, he wrote a good bit of it, so he probably knows it double. And on that introduction, I'm going to ask Brett to switch over the control to Jim's computer because he is going to be showing, he is going to be going live onto the internet, and it looks like that has happened. So Jim, really, usually I ask some questions, but today this is really more of a presentation. So why don't you start rolling, and if for some reason I just have a question that really needs to be asked, or I see one from one of our people listening, I'll interrupt you, and otherwise I'll let you try to get through the material. Again, he's going to do a little introduction on why the change, and then he's going to try to do a live demo right on the internet, just like we will be doing possibly in a couple weeks, I guess.
Yeah, I'm gonna try and not rush through my intro, but yeah, I'm gonna try and rush through my intro so I can get to the demo and then hopefully take some questions. Okay, let's get started. Thanks, Greg. Thanks, Michael, Alan, Peter, and Melissa. Wonderful presentations. Had a fun time listening to you, and thanks everybody for listening in today. Welcome to, I'm going to give you a special preview of the Cost of Capital Navigator, which is Duff and Phelps' new online resource for estimating the cost of capital. In a moment, I'm going to tell you all about it, when it's coming out, what's in it, how it works, how to subscribe, and then I'm going to do a live demo, and then hopefully answer some questions. So let's get started. Let's flip the page here. Can you tell I'm reading? I've got some stuff to read up in front of me. I'm Jim Harrington, and as Greg said, I'm a director in Duff and Phelps' Chicago office. Along with Roger Grabowski and Carla Nuns, I'm co-author of the Duff and Phelps Valuation Handbook series. Here's the obligatory disclaimer that we must put in all Duff and Phelps public webinars. And let's just dive right in. As you know, Duff and Phelps has been providing the cost of capital data and industry data in the Valuation Handbook series since 2014. And there are 4 valuation handbooks. 2 provide U.S. cost of capital and industry data, and 2 provide international cost of capital and industry data. In 2018, we're going to transition all 4 of these books, Critical Data and Information, over to the Cost of Capital Navigator, a new online platform. The first book to be transitioned, we're going to transition over, is the Valuation Handbook U.S. Guide to Cost of Capital. The other 3 books will be transitioned over in 2018, later in 2018. But I'll tell you when the Navigator is going to come out, and that's the first one is the U.S. Cost of Capital that's going to be transitioned over. But everything's going to end up in the Navigator, and from that point on, you'll be able to access all of that data and information on your desktop, your laptop, or on a tablet. Now, the Cost of Capital Navigator becomes available or launches in the second half of February 2018 with data through December 31st of 2017. And as I mentioned, the books are going to be transitioned over to the Cost of Capital Navigator in stages. In the first stage, in February 2018, the Valuation Handbook U.S. Guide to Cost of Capital is going to be transitioned over. This is the book that most people are most familiar in this audience with, in all likelihood. This is the book that includes the CRISP decile size study and the risk premium report study. This is the book that includes the size premium, the industry risk premium, the equity risk premium, and the risk-free rates that people have used and trusted for years to calculate cost of equity estimates for U.S. companies. People have been using this data for years. The Duff and Phelps Cost of Capital Navigator helps analysts properly use and take full advantage of all of the data and information available in it. Greg said, I'm going to talk a little bit about while we're putting the Navigator out. That's one of the big reasons. It helps people take full advantage of all the data in it, helps them use it correctly, and provides documentation. But let me just real quick run through the benefits of the Navigator. Online access, I already mentioned. You can access from your desktop, laptop, or tablet. Faster delivery of data, up to a full month earlier. You're going to get your year-end data for 2018 about a month earlier this year. The quarterly updates are now included with every subscription at no additional charge. There's comprehensive, auditable documentation. There's comparisons to the industry. When available, the Cost of Capital Navigator is going to provide comparisons of your subject company's results to industry statistics for context. One that was really requested from the toolkit and the old Cost of Capital Analyzer is you can now save your work. With the Cost of Capital Navigator, you can save your work, you can go back, you can review, modify, update anytime you want, as many evaluations as you've got in there. Online help and support. You can print out background text explaining the theories and derivation of the data in the Navigator. And finally, sort of cliche, but it's true, you can save time and reduce errors. Absolutely true. Now, we've talked about how all the critical data from the valuation handbooks is moving online, but a lot of people are going to say, what about all the great content from the books? Okay. For example, can I still read about the latest research on the size effect or learn about how the monetary actions, the Fed's actions affect risk-free rates, or read about the equity risk premium? And the answer is yes. All of the great content, all of the great examples, frequently asked questions, methodology, etc., from each of the valuation books from 2014 forward, including all of the new stuff for the 2018 year, which we're working on now. The guys are working on that now, and that'll be out next month. Year-end data will be available in the Navigator fully. It'll be organized by chapter, it'll be fully searchable, and it'll be printable. Okay? So everything that you got before in your book is going to be there, including all the data. We're also, for people that really would like to just hold a book or have a book, we're also offering a print-on-demand book that includes the theory behind the Cost of Capital Navigator platform. The book will be $45, and it'll be available through the platform. Some important things to remember about this book are the book is soft copy and contains all of the important text from the most recent year only, and includes examples for properly using the data. However, the book does not include any data exhibits. The data exhibits, the valuation data, the size premium, the industry risk premium, the equity risk premium are available for use through the Navigator only starting in 2018. But it's all there. It's all there, including all of the text that you'll need to understand it. The book, while it doesn't contain data exhibits, and that's an important thing to remember, so don't order the book thinking that it's going to have the tables in there, because it's not going to have the tables in there. The book is, like I say, for reference. It's a wonderful way to train new staff. It's a wonderful way to just read about. If you want to hold the book and read about it, that's where you get it. But you can also read about it online and print out online, because it's all there. The Cost of Capital Navigator has two subscription options. The first subscription option is the basic subscription. It provides you with access to the most recent 2 years of data, valuation data, plus all of the March, June, and September quarterly updates that are associated with that. And as I said, those are included, no additional charge. Used to be an additional charge. As of the launch of the Navigator in February 2018, the two most recent years are 2017, which is last year's book, and 2018. That's the stuff that we're working on now, just like usual. That's going to be out next month with data through December 2017. The second subscription option is the Pro subscription. The Pro subscription provides everything that's in the basic subscription, but also gives you access to the historical data going all the way back from 1999 through 2018. And people ask me, you guys didn't publish the books, and you just started that in 2014. What's this 1999 stuff? Well, we have the rights from Morningstar. We have a great relationship with Morningstar, who used to publish the SBBI Valuation Yearbook, the old blue book. We have the rights to distribute all of the data from the Valuation Yearbook, the old SBBI Valuation Yearbook, all of that, the CRISP decile, size premia, the industry risk premia from 1999, which was the first year that was published, all the way through 2013, and then in 2014, we picked it up. So you've got all that coverage. The Pro option, really, for anybody that needs to do a historical valuation or a valuation of the past, that's where you would get that data. It's all available as published. Let's go over the pricing real quick, and then we're going to get to the demo. The pricing in 2018 is as follows. The single user basic subscription is $350, which is a savings because from the $490 price previously charged for the Valuation Handbook, U.S. Guide to Cost of Capital, plus the quarterly updates, which were an additional, charge, but they aren't this year. So you're actually saving money. And also, you have to consider with the basic subscription, you're also receiving 2 years of data this year. Instead of just buying, one book, you get 2 years of data. With the Pro subscription, let's move on to the Pro subscription. Oh, first, let me say, the first seat for the basic is $350, and then you can add as many seats as you want for $199 each. With the Pro subscription, the single user price is $689. That's the one with all data from 1999 through present, through 2018. And that is compared to the toolkit, the BDR toolkit or the value source analyzer, which are not going to be around this year. The value source and BDR are distributors of the Navigator. But the Navigator, or the toolkit, and the analyzer only had 2 years of data. The Pro subscription has that, 1999 through present. I think that's almost 20 years of data now. With the Pro subscription, the first seat is $689, and then you can add additional seats up to 24 seats for $389 a piece. And then after that, we have something for for firms that have got more than 25 or more users. You can just call us. We call that enterprise licensing. Call us and we'll work that out. And that is a negotiated price where you can actually get a better volume discount, basically on a per user basis by doing that. Now, I do want to put up that Value Source, you can purchase Value Source. NACFA, you can purchase the Navigator through NACFA. Here's all of the information. NACFA is sponsoring this webinar, as you know. So here's all their information. You can call them, you can email them, and they've got a site up where you can learn about the Navigator. Okay, go to that and tells you all about it. Now, let's do the a live demo. Greg, do you have any questions so far? I know I'm sort of whipping through this pretty quickly.
I think it's been excellent, and I'm just keeping my fingers crossed about this next part. Only because
you're keeping your fingers crossed that I'm not going to crash my web browser. It will be fine.
Well, these things seem to happen whenever you're on the air. So, and I don't mean you. I mean in general.
Yeah. Here, I'm looking for some notes that I had someplace. Just a second.
Also, actually, I think we need to do a polling question right now,
Oh,
which
do a
I thought
polling
was
question.
supposed to be tucked in here. So maybe Brett can figure out how to do the polling question. There we go, while you find your notes.
Yep, thank you.
I think this is fascinating. Of course, I know I'm getting old because I really want to book, but I want to book with the tables because I'm just a pain, which I think is what old guys become. So I somehow the computer, even though I know it's not a black box, it can all be researched and proven. It feels like a black box. I don't know what else to say. I'm sure after months I will be able to slice and dice and be so much more comfortable with the build-ups I'm coming up with. But sitting on this side of it,
Yeah.
just
Well, let
kind of
me
how
ask you,
it
Craig,
is.
can you see my web browser now? Or are you
They
still
have
on the?
they have the poll up, but you will be right back in just a minute.
Got it.
As soon as up, you are. I think. Yep. There you go. All right. Did you find your
Okay,
notes?
am I back live?
Yeah. And if you found your notes, it worked perfectly because I might have forgotten to do the polling question, and that's a bad thing. So you're
You want
off
to do
again.
it right now? You want to do the polling question right now, or no?
No, we did it.
Oh, you did it. Okay.
Yep. Perfect.
Perfect. Okay, now let me ask first, do you see my web browser with the Duff and Phelps splash screen up here?
Yeah, with a picture of a guy going through above ground tunnel, I guess.
That looks like Heathrow, actually, I think.
Okay, perfect. You're
Okay.
You're a world traveler. I'm very domestic, so.
Yeah, you know. Okay, let's get to it. I want to show you a demo of the Duff and Phelps Navigator. So let's just go to that page.
Yeah. And Jim, you got about 20, 21, 22 minutes left, just to give you a gauge of where you are timeline.
Okay. I've actually already cut out some of the things I was going to do. I think an unlevering and relevering example of stuff, but I think what I'm going to do is just give you an overview of what the thing looks like, because I know we'll probably have some questions at the end.
Perfect.
Okay, this is the login screen. The Navigator, the Cost of Capital Navigator is web-based, so you can, like I say, you can access it anywhere. We'll just get rid of this big terms and conditions thing, and we'll log in. You log in here just like you log in on any website. In this case, we just use our email and a password, which we will supply you with. Okay. Logging in takes us to the home page. As you can see up here, I'm test user 3. On the home page, on the left, let's say on the right here, the blue button's more visible. On the right, you can start a new cost of capital estimate. On the left, you can review all past estimates. They'll all be saved. You can go back to them, review anytime you want. So let's take a look at let's take a look at my previous estimates real quick. I don't have many in here. Looks like I've got about, 9 or so. Let's just take a real quick look. What is this thing, what does this page look like? On the left here, I can go to say I did a valuation for Aaron Company. I can click on the right here on this and see some high-level information about it. The author, test user 3, that's me. Last edited, the valuation date, what industry Aaron Company was in. It looks like Aaron Company was in SIC 36. Electronic and other electrical equipment and components. Just some high-level stuff to remind me of what was going on there with that. Over here, on the right, I can go in and I can edit that. I can go back into the valuation and edit it, change the assumptions, etc., rename it or duplicate it. Here, I think I'm just going to rename it real quick. I said that Aaron Incorporated, Aaron Co. was in the electronics business, so let's just change this to electronics so it's a little more descriptive. Okay, I mean, just real simple. But what we really want to do is I want to go back to the home page and I want to start a new cost of capital estimate. So let's go back to the home page and let's start a new cost of capital estimate. And let's, here, Zach Rodham's sitting here with me, so we're going to do Zach Company, okay? Zach's sitting here making sure that we go right on the technology. And I'm going to hit save and continue. And here it takes me to a real simple page after I saved it as Zach Company up here. Okay, the first thing the Navigator is going to do, it's going to ask me 4 really basic questions. The first one, valuation date. What is your valuation date? And you can see it's a standard calendar. This actually goes all the way back to, as I said, December 31st, 1998. Okay, because the first valuation data that we've got is the 1999 SPBI Valuation Yearbook, and that was data through December 31st, 1998. But today we're going to use something a little bit more contemporary. We're going to use the data through date of last year's 2017 book, which was December 31st, 2016. Now these next ones, home country, United States, investee country, as I mentioned, we're doing the valuation handbooks are being loaded up into the Navigator in stages. The first one is the Valuation Handbook U.S. Guide to Cost of Capital. That was the one with the CRISP decile, size premia, etc., the risk premium report. And so right now, the home country is always, you're an investor based in the United States evaluating an investment in the United States, which is what that book did. After we had the international books, the International Valuation, International Handbook, International Guide to Cost of Capital, and also the Industry Cost of Capital, then this home country is going to have 55 additional home countries. In other words, you can do valuations from the perspective of an investor located in any one of 56 different countries, including the United States, into evaluating an investment located in any one of 180 plus different countries. So, example, you could do United States into the United States, or United States evaluating an investment in Germany or Brazil, or a Brazil investor investing in Poland, or so, so there's a lot of combinations. Right now, it's United States, United States. Now you can put in industry, another real key. Just 4 simple questions gets us started. Valuation date, home country, investee country, in industry. Let's just stick with what was Aaron Incorporated. It was electronics, so let's just do that again. I can type in like a word, and okay, I'm going to go. I could go with that. It'll look it up. Or since I know what Zach Incorporated does, he's in SIC 36. I can look it up that way too. So I'm just going to do that real quick. And let's close out of my email because that's dinging. Sorry, Greg. Okay, so now I've got my 4 questions answered. The Navigator knows enough to get us started here, and we'll just get started. The next page brings us to this. The Navigator is all equation based. Don't let that intimidate you. I think that everybody knows what this equation up here is. That's just the CAPM. Okay, up here at the top is a key. It's all labeled up. Cost of equity capital equals the risk-free rate plus a beta times RP sub M, risk premium for market, in other words, an equity risk premium, plus a size premium. And that's always up there. You can hide the key. You can show the key. I like to keep the key up there just to keep me straight in what's going on here. And you could do you could do the CRISP deciles CAPM. You could do the CRISP deciles build-up. If I click on the build-up, it automatically pulls up the appropriate equation. You notice the equation changed. I can also change data sets. What does the Navigator include initially? It includes the CRISP decile size study. That's all the size, premium, etc. It used to be in the SPBI Valuation Yearbook, and now the Valuation Handbook. But it also includes the risk premium report study. Okay, so you can do a CAPM under that too, or a build-up, or a second build-up that includes an industry risk premium, or you can even use the risk study, which is a completely different way of estimating cost of capital, cost of equity estimates using fundamental accounting-based things like operating margin and coefficient evaluation of operating margin, etc. But it automatically pulls up the appropriate equation. So why don't let's just get started and do a simple example. Let's go back to the crisp decile size study. Let's just do a build-up. Many people in the audience do build-ups. They also do CAPMs. We're going to do one of those too. I do recommend whenever I speak, I always say try to approach things from different directions. Not only use different models to lessen model risk. In other words, sort of calculate cost of equity capital using different models and different data sets. In other words, CAPM, build-up, data set would be risk premium report or crisp deciles. We're going to do both. Let's start with CAPM build-up. So it's all equation-based, so I just come down here and let's do a risk-free rate. I click on that, and I could type in anything I wanted. Say if I get my risk-free rate from whatever source that I'm using, I can click, and type that in, or I can go over here and I can just pull something off the shelf, and the Navigator will give me a choice. In this case, I've got the spot rate from the Fed, and I've got the Duff and Phelps normalized rate as of my valuation date. Okay, and I'm going to click the spot rate. That spot rate, 2.79%, is from the Federal Reserve's historical 20-year constant maturity Treasury. Okay, pulls that in for me as of my valuation date. My next thing is I need an equity risk premium. Again, I can type in anything I want. If I got something from Demoteran, I can type that in. If I want to use something off the shelf, here, let's just scroll down a little. In this case, I used the spot rate for the risk-free rate, so I'm going to use the long-term historical 1926 to present, used to be called the Ibbotson ERP. I'm going to use that. 6.94% is what that was as of my valuation date. Navigator fills that in, and you notice something else that's really cool here is it labels these below. I use the spot rate. If I had typed in something, it would have put custom rate down there. But in this case, I used the spot rate. In this case, I used the historical long-term 1926 to present ERP, so it labeled it up for me. Here, I need an industry risk premium, so I'm going to click on that. Again, I can type in a beta. Okay, remember, an industry risk premium is nothing but a beta centered around 0, so it's an up or down adjustment within the framework of a build-up equation. So I can type in a custom beta if I want to, and the Navigator will automatically translate that into an industry risk premium for me. Or, again, I can use something off the shelf. In this case, what did I say? I gave my valuation date. I also said that ZAC Incorporated participated, the industry that ZAC Incorporated operates in was SIC 36, the electronics and other hardware business or whatever it was. So it pulls that up for me, okay, as of my valuation date, and automatically translates that into an industry risk premium based upon what equity risk premium I used. I'm just going to click Save. Okay, and the last thing we need is a size premium. And I'm just going to real quick, I'm going to use the example that Roger has used in the book for a long time, 120 million for market cap. And I hit Save. Oh, something I want to show you. Down here, with the crisp decile size study, I could put that 120 puts me into decile 10, or in microcap, or in a breakdown of the 10th decile, 10 W, X, Y, and Z, 10A, 10B. The Navigator automatically pulls up based upon your market cap guesstimate here, okay, so which enables you to choose a size premium. It pulls up all of the portfolios that you could possibly fall into. In this case, I'm going to choose just something very simple, decile 10, just straight up. The reason I'm choosing that is 120, which is my market cap guesstimate, falls smack in the middle of the breakpoints here. of 1.963 million and 209 million, sort of right in the middle. I'm nice and comfortable, just sort of in the middle. That's the one I'm going to use. I'm going to hit save. And at this point, we have calculated a cost of capital estimate for Zach Company using the Chris Deciles buildup. Now, what did I mention earlier? I like to approach things from different directions. Let's just real quick, let's duplicate this equation. I just clicked the duplicate button, okay? It duplicated the equation. And this time, I would really like to sort of see what this would have looked like had I used, say, for instance, the Duff and Phelps normalized rate of 3.5% instead of the spot rate, and the Duff and Phelps recommended equity risk premium, which is paired with that risk-free rate as of our valuation date. Okay, so that's what that enables me to do. I've now calculated using two different scenarios, one using the spot rate and the long-term historical equity risk premium, and one using the Duff and Phelps normalized rate and the Duff and Phelps recommended equity risk premium as of my valuation date. Okay, and to keep things straight, what I'm going to go in and I'm going to rename these scenarios. I'm just going to name them spot, just some kind of note here, spot rate, if I can spell, spot rate and historical ERP. In this scenario is what I used. In scenario 2, what did I do? I used a normalized rate and DP ERP. Okay, so then it makes it a little bit more descriptive, but I've got two scenarios now. Now, I've got two estimates using build-up. Let's move on and real quick do something with the risk premium report. Now, the risk premium report is a little bit different than the Chris Deciles because the Chris Deciles, the old IBITs and stuff, calculate size premium based upon what? Market cap only. The risk premium report calculates size premium and risk premium over the risk-free rate, etc., using market cap plus 7 additional measures of size. So you can see, let's just close these up so we can see exactly what we're working with here. I switched over to the risk premium report, and you can see I've got two scenarios. Remember, I named them spot rate and historical ERP and normalized rate and DP ERP. Let's just open up this spot rate and historical ERP. Once again, the familiar key up here. Let's do a build-up first because we did a build-up over in the Chris Decile. So let's do a risk premium report study build-up. Okay, and for our first scenario, we used the spot rate and historical ERP. You can see in this, the Navigator remembered, okay, for scenario 1, Jim wanted to use the spot rate, carried it over from our first estimate from our different one. It also did what? It remembered that I'm using the historical ERP and actually has already calculated a component of the risk premium report buildup that is oftentimes overlooked, and you should remember it's called the ERP adjustment. This 2.01% is already calculated for us based upon the fact that in scenario 1 we wanted to use the spot rate and the historical Ibbotson ERP. It's already calculated. So what do we need? We need to now pull in our risk premium over the risk-free rate based upon our size measures. The first size measure that we use is our market cap. Now remember when we did our CAP-M, or our build-up under the Chris Deciles, we had a guesstimate of 120 million. That's what we used in order to know what to use for our size premium. Okay, which portfolio, which decile to use. We selected decile 10. Here, the Navigator remembered carried over our market value of common equity, in other words, our market cap estimate of 120, has already looked up the appropriate risk premium over the risk-free rate for a market cap of 120 million. And that risk-free rate over the risk premium over the risk-free rate is 13.07%. Fill it in. Here is our third estimate for our company. Now let's just real quick, we're going to real quick Now, where did I put those again? Here we are. I'm going to fill in all of the other 7 size measures. Remember, the risk premium report has not only market cap, but 7 additional size measures. So I'm going to use the one that Roger Grabowski's used for book value of equity. He always used 100 million in the examples in his risk premium report. For 5-year average net income, which is another measure of size, 10 million. I'm going to put in 180 million for my market value of invested capital, my MVIC. I'm going to put in 300 million for my total assets, another way of telling how big a company is. I'm going to put in 30 million for average 5-year average EBITDA. I'm going to put in 250 million for net sales. And I'm going to put in, I've got 200 employees. Can you use it for smaller companies? Absolutely. I mean, the Navigator is designed just like the risk premium report was designed to use with very small companies. I just, for the sake of making things easy, use the same examples that are in the book, basically, in the old book. Okay, as you can see now, I've filled in all 8 measures of size, and now I've got an additional 8 estimates of cost of equity capital using spot rate and historical ERP risk premium report buildup. Now let's go down here and look at, we had a second scenario. Remember, we did a second scenario where we wanted to see what this would look like with the Duff and Phelps normalized risk-free rate of 3.5% and the equity risk, the long-term Ibbotson equity risk premium. And you can see we filled in all our size measures, and so that scenario is already all filled in. So now we've got an additional 8 estimates of cost of equity capital. So what have we done here in about 5 minutes? For Zach Incorporated, we've estimated cost of equity capital using 2 different data sets and 2 different models, the CRISP decile size premium, the study, the old Ibbotson stuff, and 2 ways, and we've calculated 16 ways using the risk premium report already. So we're sort of zeroing in on what we think our cost of equity capital is for Zach Incorporated using a couple different things, using the different models. We can also do a CAPM. Okay, let's just do a CAPM real quick. Risk premium report CAPM. I do suggest not only do you use different data sets, but you use different models. We've done 2 buildups. Let's add a CAPM. Here, we entered all 8 size measures in our risk premium report buildup method. The navigators will, of course, remember what our size measures were, for instance, for market cap, market value of common equity, in other words. It remembered for both our CRISP deciles and for our risk premium report buildup, we used 120 million. It's going to remember, okay, but I do need to go through to tell the navigator and confirm that I want these used in my summary. And the way I do that is I just click on them, 100 value for our book value, and I just click Save to confirm. I'm telling the navigator, yes, include this model and these estimates in my final summary. But you don't have to retype all your values. You just go through here and confirm. Okay, now what have we done? We're up to what? 16, we're up to two estimates with CRISP buildup. We've got 8 estimates with 16 estimates with a buildup, 2 different scenarios for our risk premium report, and we've got an additional 8 estimates with our spot rate and historical ERP for a risk premium report, CAPM. You remember, it's already automatically calculated for our normalized rate and DP ERP, normalized rate and Duff and Phelps recommended ERP for our CAPM. So now we're up to 32 different estimates for Zach Incorporated in less than 5 minutes, well, maybe 10 minutes. So we're sort of zeroing in. I did want to show you some unlevered. You can actually do, with the Navigator, you can do unlevered estimates, okay? All of what I've shown you here is sort of the off-the-shelf, what we call levered at using the guideline portfolio that used to be printed in the tables in the book. We've calculated those assuming that these companies have a capital structure equal to the capital structure of the average companies in the portfolios that were in, say, for instance, the risk premium report A or B exhibits. But you can also use the Navigator to automatically tell it to unlever your estimates down to zero debt in the capital structure, and then relever it. Just say, hey, I want this capital structure, and it'll automatically relever your estimates to whatever you want. And that's a very typical thing with what analysts do. They say, I've got these comparable companies, okay, and all of my comparable companies, pretty much the industry, in other words, the peers that I'm comparing my subject company to, have a capital structure of around 25% debt and 75% equity, okay? But my subject company, Zach Incorporated here, has actually, it's capitalized at 60% debt, okay? Or after this thing is sold, after we value it because presumably somebody's going to buy it, after it's sold, maybe the new owner wants to redo the capital structure and take on more debt and reset the capital structure going forward to a different one. So I'm going to redo that. I'm going to take it down to zero and relever it at 60%, which is what I think Zach Incorporated either is or will be going forward. Navigator does that all for you automatically. So anyways, I've showed you 34 different ways now of calculating. I also told you that you can unlever and relever your estimates, which we didn't do here. Another thing, some people will have estimates that are in need of what we call a high financial risk or a company in distressed estimates. We can also, if you as an analyst have deemed your company to be in distress, in other words, troubled, the Navigator will automatically calculate. You just give it some additional information about your subject company, and it will calculate what the cost of equity capital would be, assuming that your company is in distress. Not necessarily bankruptcy, but probably close to it. Like it's troubled. It's a troubled company, but that's up for you to decide. But you can tell the Navigator to do that. Now here, what we've come up with, we didn't do the unlevered and the relevered and the high financial risk because we're really limited time today. As a matter of fact, I think I'm about out of time.
Yeah, we are really limited. So do your best to summarize this.
I'm just going to summarize. Here we get to the summary page. It gives you a summary. All of those 34 at this point, you could do more, estimates are all telescoped down into, you can look for my levered estimates using 2 different data sets and 2 different models built up in CAPM and the CRISP deciles, the old SBBI stuff, and the risk premium report. I came up with an average cost of equity estimate of 16.39% for my company and a median of 6.33. We put it in a graph over here. You can see the range. The low estimate was 15.1 out of those 34 estimates. The high was 18.1% out of those 34 estimates. And the median and the average are graphed there in the middle. Now, in this case, we were a pretty small company in the 10th decile. So right now, the Navigator will pull up from the U.S. industry book that we publish, where we calculate the cost of equity and trading multiples or valuation multiples and betas and all that other stuff by industry, about 350 different data points by industry every quarter. It pulled in a real simple thing to compare it to. This is the SIC composite for this industry, and it shows that. Going forward, hopefully with the first iteration next month or maybe a month or 2 after, we'll add a thing where you can toggle between the small composite, the large composite, the high financial risk composite, and pull that information in from the industry book so you can custom tailor what your comparisons will be. Down here, just real quick, all of your general inputs are valuation date, industry, etc. All the inputs you used are down, are documented, the assumptions are documented, the sources are documented, and then down below it runs you through by data set, CRISP deciles, or risk premium report and model. It will run you through a thing. And then up here at the top, obviously you can click on this little button right here, and what it does is it prints you up a PDF of that you can save. And I want to be clear, this big watermark is on there because I'm in the test server right now, and we had some beta testers in there. The watermark will not be on when you do it. That'll be taken out. That was just for our beta testers. But all of that, and it will be exportable to Excel. Okay. And speaking of Excel, something that's coming up later in 2018, not with the first release, but another piece of this that's coming, that's the highest priority after we get the basic, get the Valuation Handbook U.S. Guide to Cost of Capital with the CRISP decile size premium and the risk premium report, all of that U.S. data up. The first priority will be adding an Excel plugin. Okay, that'll be added in 2018. I know a lot of you have got your own models, for instance. Right now you can export these summary results to an Excel spreadsheet and then copy and paste over to your own models. Okay, what we're adding after the first rollout is an Excel plugin where you can literally pull in any and all of this data by cell within ranges into your already pre-existing models that I know a lot of you have built out over the years using this data. Greg, I ran over just a couple minutes. I'm sorry.
Yeah, but this was fantastic. Why don't you hang on? I believe I have a question you haven't answered, although it was very good for the time you had. Brett, can you go on and show the last polling question? I will mention while we're switching over, next month we're featuring Lee Fredrickson again on Marketing Your Practice with Kathy Knapp. Melissa Gregg will also be interviewing Ed Meisenland on emotion in transactions. Being a deal guy, it's one of my points that I don't think can ever be emphasized enough. Jim, while they do the polling question, is there a field? There doesn't appear to be a field for specific company risk. How will we do that into the Navigator, or did I just miss something?
No, you didn't miss something. Am I back? I'm back on. I don't see.
We can hear you, and you're just going to have to be heard.
Okay. Okay. Yeah, that's a great question. Company-specific risk, they're going to add a field, obviously, so somebody, to all of the equations, okay? So all of the equations, there's going to be a field in there. That'll probably be in the first iteration. I just talked to Kevin Madden, who's the project manager for getting this all out next month. He's done a wonderful job. Him and the rest of the team have done a wonderful job getting this up to where we are right now. There'll be a field added so that you can add your own company-specific risk if you choose to do so into any of the models, and that will be included into your summaries. Now, as far as calculation of that type of thing, I want to break that up into a couple of different, and I'll keep it short, Greg. You're looking at me like
real short.
Real short. You'll be able to add that, your calculation or your estimate of company-specific risk, okay, to any of these equations that will be included in all your estimates in the summary, etc. But also, there's a thing that we have that's scheduled. And Kevin, I talked to Kevin, he's about 80-90% that in the first iteration, this capability will be in the first iteration. And that's actually the using the C and D exhibits in conjunction to do the comparative risk study. Okay, now comparative risk study enables you to do a real specific thing. It enables you to fine-tune your estimates using the off-the-shelf guideline portfolio, size premia, risk premia over the risk-free rate, etc., that are in the CRISP decile size study and the risk premium report study to change, specifically the risk premium report study, to change, to fine-tune your estimate of cost of equity capital based upon the differences your subject company may have from the characteristics of the companies used to calculate each of those 25 portfolios in the risk premium report. Now, that sounds really complicated. It's not. It's a great capability that we're adding that will enable you to say, you know what, the characteristics, which we've always published for the risk premium report, of the companies that make up the portfolio, I fell in portfolio 25 or 24, the characteristics of those companies are X, Y, and Z. My company is just a little different than X, Y, and Z. You'll be able to tell the Navigator what your company's X, Y, and Z are, and it will automatically tweak up or down. It'll make just a real simple little adjustment based upon your differences with the actual risk premium report portfolios, which is, I think, going to be a pretty cool thing. We've explained in the book for years how to do that. Kevin says he's about 80% sure in the first iteration next month, because this is coming out the second half of February, okay, that'll be in there, if not shortly after that. But at the very least, that field will be in there for you to type in your own calculation of that type of stuff. What else, Greg?
I think we're going to have to conclude, but boy, what I will say is this sure sounds like a fantastic tool. It sounds like doing these build-ups is going to become a much more complex and interesting thing to do. And I can't wait until somebody
It's going to be easier.
Oh, easier, but it's going to involve a lot more components probably when you investigate the different ways that were not so available in the book. And I can't wait till somebody teaches me how to explain all of this succinctly, because it's
really easy.
No, I get it, but it is a little more complex, and that's awesome. So thank you. And
can I just say one thing? The big takeaways here, we're moving.
And then I got to wrap.
And then we got to run. I know. We're moving the U.S. data. That's the book you're most familiar with, the CRISP deciles, the old IBITs and stuff, and the risk premium report first thing next month. That'll be in there. From that, you just saw me calculate using all of that data, all the industry risk premium in there, all of the equity risk premium, all of everything that you were able to use in the book is in the Navigator. Completely usable from 1999 through present, depending on which subscription you go for. Okay, it's in there. It makes it easy. It automatically calculates all of this stuff for you. Make sure that it gives you the ability to choose what you're doing, just like usual. But it also keeps you from misusing the data by accident. Okay, also, in the future, we're going to add in all of the industry data from the U.S. industry book, so that, in more than just a simple comparison of just the cost of equity capital, but all of the other data from those books, the betas, the trading multiples or the valuation multiples, everything, the WACs, everything will be in there. So stay tuned. All of that is coming. It's going to be absolutely fantastic. Like I say, you just saw me calculate cost of equity capital 34 different ways in about 10 minutes for Zach Incorporated, using the best data sets that everybody uses and that you've used forever. It's all right here. And don't forget, we're not going to print hardcover books this year, but you can still buy a soft copy that does not include the data tables, but everything that you want to read by chapter every year is up there in the Navigator, so you don't really need the book, okay? It's up there. It's all searchable, printable, whatever you want, okay?
And
that's
fantastic. On that note, we are going to wrap today's session of Around the Valuation World. I will see you next month. I believe it's the fourth Monday in February. Should have wrote the date down and didn't. But we look forward to seeing you all then. And I thank you for staying on a little long. I do think this information was worth it. And I just think this is amazing what Duff and Phelps is doing and making available to all of us, which I can't say I really thought before the presentation. So thank you so much, Jim. And, thank you,
okay, well,
everybody.
thank you very much, and thank you everybody for listening. And bye-bye, Greg.
And now hopefully Brett's going to push the button and we're going to conclude.
Hey, Brett, have a good one. Thank you all.
Thank you, Jim. Thank you, Greg. Have a great day, everybody.